This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Would you be open to some ideas today? Maybe taking advantage of some opportunities and unintended dislocations? Well, I hope so, because that's what I'm going to be talking about on today's Wise Investor Show. Underutilized and otherwise formerly unintended ways that you might be able to use 529 plans in your and your family's financial planning. When you think of 529 college savings plans, do you think of them as a nifty estate planning tool? How about a means by which to get it into a Roth IRA for your beneficiary? Or have you ever thought of 529 plans as potential state income tax deduction factories? A lot of us think that 529 college savings plans are really only designed to be used for college. And well, 25 years ago, that was pretty much the case. But what if I told you that through a series of pieces of legislation, 529 plans could potentially have much, much broader utility for you and your family than you otherwise might have thought? Hello and welcome to the July 26th edition of the Wise Investor Show. I'm Greg Smith, Senior Financial Planner with the Wise Investor Group, one of the top wealth management teams in the nation, as recognized by both Barron's and Forbes, and I sure am delighted to be here with you today. Thanks so much for making me part of your day. I've got a lot to share with you on today's podcast, so let me get the preliminaries out of the way quickly first. The topics I'm going to speak about on today's Wise Investor Show are simply my ideas and observations, and I would strongly encourage you to speak with your tax advisor, your financial planner, and or your attorney before implementing anything I talk about on today's show. And with that, let's get to it. Well, you probably already know 529 college savings plans are those college savings vehicles that have been around for more than 25 years now that allow you to create a tax-free account that wasn't there before for future education costs, with some of them potentially offering state income tax deductions. And as long as the funds come out of your 529 plan for tuition, room, board, books, and fees, etc., well, then the funds come out tax-free. With 529 plans, unlike the Coverdell education savings accounts, there are no income restrictions, which means everyone qualifies for these, and the limits of contributions are enormous, whereas the limit for Coverdell education savings accounts is $2,000 per year. So really, once 529 plans hit the scene, we in the financial planning community all but stopped hearing about Coverdell accounts just because, well, 529 plans were simply so much better. You'd think that that would be enough, right? Creating a tax-free account where there previously wasn't one and being able to get all those years of tax-free growth and compounding seems like a pretty nifty deal in and of itself, and it is. Anyone who has a 529 plan will very likely tell you that they're glad that they opened it up when they did and saved into it. But what makes 529 plans all the more interesting is based on different legislative changes that have relaxed some of the rules associated with 529 plans that make financial planners like me want to pass along to you and have you consider some of the lesser known uses and benefits that 529 plans have that otherwise wouldn't be front and center to us, but they might be of interest to you for your personal financial planning. Well, the first thing I want to mention is that 529 plans don't necessarily have to be used for your beneficiaries' college years. Now, as a financial planner, I'd rather that you use your 529 plans for college because that translates to more years of compounding. Time is your friend when it comes to compounding, and I always hesitate to disturb the compounding process earlier than necessary. But that said, as a result of the Secure Act 1.0, you can now use your 529 college savings plans for expenses associated for your youngster or your grand youngster, for tuition costs as early as kindergarten, for public, private, or religious elementary schools. There's a cap on how much you can distribute out of your 529 plan each year for these qualified tuition expenses, but that limit has been increased as a result of the recent bill that just passed earlier this month. that increased the amount you can take out of your 529 plan from $10,000 starting next year then to $20,000 per year for tuition for kindergarten all the way up to 12th grade. And further, you can take money out of your 529 plan for things now like online educational content and tutoring, testing fees such as prep for the SAT or the ACT, and costs associated with educational therapies for students with disabilities. So whereas 25 years ago, 529 plans were for college and beyond only, that was it. Well, that's not the case anymore. The rules have really relaxed when it comes to what you use your 529 plan money on and when. So there's much broader utility and choice for you that wasn't there before. The next thing I'd like to share with you is that some states with 529 plans can offer some interesting and nuanced state income tax benefits. Now, I'll once again advise you to speak with your CPA or your tax preparer before implementing or acting on anything I mention here. But the idea is to be aware of your surroundings. There are some states in the U.S. that offer state income tax deductions for 529 plan contributions no matter what state's plan you contribute to. Take my home state of Arizona. An Arizonan, as they're called, could open up a Virginia 529 plan or any state's plan for that matter and take a $2,000 state income tax deduction for single filers or $4,000 for married couples filing jointly. There are several states in the union that offer that kind of flexibility, which is referred to as tax parity. So if you live in one state, you participate in another state's 529 plan, you're able to take a state income tax deduction. That's referred to as you're living in a tax parity state for 529 plan state tax deduction purposes. In addition to Arizona, if you live in Arkansas, Kansas, Maine, Minnesota, Missouri, Montana, Ohio, or Pennsylvania, you too get the additional benefit and choice where you can open up any state's 529 plan and take a state income tax deduction in your home state. Once again, in case you missed it, the tax parity states in the United States are Arizona, Arkansas, Kansas, Maine, Minnesota, Missouri, Montana, Ohio, and Pennsylvania. 9 different states. 9 out of the 50 United States offer that intriguing little extra nuance. So do please talk to your local tax preparer about what your state income tax benefits might be, as they may vary from state to state and could change at any time. In addition to that, there's only one state that offers unlimited state income tax deductions for taxpayers beyond the age of 70 that contribute to their state's 529 plan, and that's the state I'm broadcasting out of, Virginia. If you live in Virginia and are beyond the age of 70 and are interested in paying for your child or grandchild's or nieces or nephew's college costs, what you can do is just run those expenses right on through your Virginia 529 college plan. So in other words, if your grandchild has a tuition bill coming up and you're a Virginia resident, you can send the amount of the tuition bill into your 529 plan in Virginia and then pull it right out of your Virginia 529 plan to then turn around and pay that tuition bill. That Virginia 529 plan contribution that you just made, once again, so long as you're 70 years or more, are state income tax deductions to you. For example, let's say you're 70 years of age or older and you're going to pay $25,000 in college tuition costs for your grandchild. Rather than making the check payable to the school, what you could do is open up a 529 plan for your grandchild, put $25,000 into it with your grandchild as beneficiary, and then turn right around and send it out of your 529 plan, making it payable to the college. What you've effectively done is created a $25,000 state income tax deduction for yourself. And at Virginia's 5.75% state income tax rate, that works out to be over $1,400 that you will have just kept in your own pocket just for running those expenses through your Virginia 529 college savings plan. So So once again, for Virginia residents who are 70 years of age or beyond, this could be a wonderful planning tool, especially if you have grandchildren of college age and the desire and the means to help them pay for college. I've referred to this strategy of grandparents age 70 and beyond who wish to pay for college for their grandchild, who run these college expenses through a 529 plan, as pretty much firing up the state income tax deduction factory, because Virginia residents have the capability for some potentially large Virginia state income tax deductions. Now, while Virginia is the only state in the union that offers unlimited state income tax deductions for 529 plan contributions for contributors who are 70 years of age or older, there are a few states in the union that just have very high deduction limits. Pennsylvania and Colorado, for example, they have a state income tax deduction limit of $38,000 on a joint return or $19,000 on a single return. Illinois, Mississippi, and Oklahoma aren't too far behind, $20,000 deductible possibilities on a joint return or $10,000 for a single filer per year. So if you happen to live in Virginia, Pennsylvania, Colorado, Illinois, Mississippi, or Oklahoma, you might be in the position for some additional and enhanced state income tax deductions, depending on what you do with your 529 plans. So depending on where you live and your ability to pay for college for your child or your grandchild, it might be worth speaking with your financial planner or your tax advisor to see if you're potentially leaving state income tax deductions on the table by not making better use of a 529 plan. And typically, by the time someone meets with me as your financial planner, they've already saved and amassed quite a bit, and you tend not to get there by being wasteful. So, all right, are we good so far? If you have any questions about anything I've mentioned so far, give me a call anytime at 571-430-7200, or you can email me at gregory.s.smith@raymondjames.com, and I will be sure to get back to you. Now, when I come back, I'm going to tell you about the dislocation of the rules that are tipped in your favor when it comes to 529 plans in your estate planning, as well as ways you can think about 529 plans as a multi-generational education investment fund. You're listening to Greg Smith, Senior Financial Planner with the Wise Investor Group, Raymond James, and I'll be right back.
The new administration is certainly upturning the status quo, but you don't have to be a disruptor in your own portfolio. It could be wise to keep calm and carry on. Tune in every week as we discuss the latest financial trends and how to filter out the noise distracting you from sound portfolio management. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Thank you, and welcome back to the Wise Investor Show podcast. I am your host for today, Greg Smith, Senior Financial Planner with the 18-person Wise Investor Group of Raymond James. And I'd like to take a moment and thank our wonderful clients for being on board with us, some of whom are going on 25 years or longer. And it's because of the wonderful clients that we work with and the cohesive, talent-rich team of specialists that we have around us that have gotten us recognized by Barron's and Forbes as being one of the best teams in the United States. If you're not yet a client of ours, but have potentially been thinking about offloading the financial management component of your life so that you can be freed up to do other things that are more important to you, well then I invite you to give us a call at 571-430-7200 or email me at gregory.s.smith@raymondjames.com, and I'll be glad to chat further. Well, today we're talking about some of the lesser-known applications associated with 529 college savings plans that you might not have otherwise contemplated, but that I thought might be worth knowing about. Something that I definitely want you to know about is the dislocation of the rules to your benefit when it comes to 529 plans, because there's a definite estate planning advantage for you to be aware of. Well, first, you might be aware that the limit on how much you can give to someone for this year is $19,000. That's what's referred to as the annual exclusion. That's this year's gifting limit. Any one person can give another individual $19,000 free and clear of any gift tax ramifications. And for that $19,000 to be able to be gifted free and clear of any gift tax ramifications, two specific criteria have to be met. The first is that it has to be a gift of present interest. In other words, here you go, Johnny. Here's your $19,000. Don't spend it all in one place. Well, we know that 529 contributions aren't a gift of present interest. They're generally a gift of future interest. They're not for now. They're typically for later. And for some 529 account owners, it's for way later. So that's one condition that is generally required, and yet you're still able to make gifts to your 529 plan anyway under the gifting rules. The second condition that must be met for you to be able to gift $19,000 to anyone you want is that it's got to be a gift of irrevocable nature. In other words, here you go, Johnny. Here's your $19,000, and it's all yours. I don't expect to see a dime of it again. Not a penny. Because it's a completed gift, it's all yours now, not mine anymore. It's yours. Well, interestingly, that too is a nifty dislocation in your favor, because 529 plan accounts are perfectly revocable by you whenever you choose. Now, if you did choose to take your money back out of a 529 plan and use it on yourself, for something other than college, you would be paying a 10% penalty and ordinary income tax on the gains. So it wouldn't be the most tax-efficient alternative, but it is indeed possible. So there are two dislocations in your favor that you can make gifts to a 529 plan, even though they are neither a gift of present interest, nor are they a gift of irrevocable nature. There are two more dislocations in your favor when it comes to 529 plans. You ready? The next dislocation is that whereas in the rest of the gifting universe, or at least here more locally in the United States, we're limited to $19,000 per year as of this year. That is this year's annual exclusion. Well, if you're a 529 plan owner, you have a different limit altogether. With 529 plans, you can superfund your 529 plan if you have the means and the desire, with as much as up to 5 years worth of gifting in one single year. Under Section 529 of the Internal Revenue Code, you may make use of as many as 5 years worth of gifting for contributions this year, for a total contribution of $95,000. If you file single, and it's twice that, $190,000 for a married couple. That's 5 years times $19,000 times 2 spouses. $190,000 would be the maximum gift you could make this year to a 529 plan if you were so inclined and you hadn't made any other gifts to the same beneficiary. This would be something you'd want to tell, of course, your tax preparer about, because you'd need to file a Form 709 gift tax return and elect gift splitting if you want to contribute the full $190,000. And also, it's important to know that if you pass away before the 5 years are up, a prorated portion of the contribution may be included in your estate. But that brings us to the next dislocation in your favor. We already know that the rules are slightly bent for you and that contributions to a 529 plan are neither a gift of present interest nor are they irrevocable gifts. We also know that the $19,000 annual exclusion limit doesn't necessarily apply to you if you want to make contributions beyond that to your 529 plan, as you can contribute up to 5 times that amount if you were so inclined, and twice that if you're married. It's a nifty way for you to get a lot of money working for you tax-free for educational purposes. The last dislocation in your favor that I want to make sure that you were aware of is that with your 529 plan, you have control over the asset. You direct and allow for distributions or not. You have control over it. You can take it back anytime you want. Only it is not included in your estate for estate tax purposes. This is a big thing to know. Ordinarily, when you pass away, your attorney tallies up all the assets under your control to add up your total taxable estate to compute what your estate tax would be, if any. Well, 529 college savings plans, though completely revocable by you throughout your life, managed by you, with distributions authorized and directed by you, it is simply not included in your gross estate for estate taxes. This is a big dislocation worth knowing about. Now, it may not be as important at the moment since the estate tax limits are now moving to $15 million per person starting next year and indexed for inflation going forward. But I think it's still worth noting that you can have an asset under your control and direction that is not included in your estate for estate tax purposes. So because of that, some people will superfund their 529 plans and contribute to it until they can't contribute to it any longer, as they recognize that this could be not only an income tax-free educational asset for future generations, it could also be an estate tax-free asset as well. There are many 529 plans in the United States that have large limits before further contributions are disallowed. Even Virginia's 529 plan has a limit of $550,000 per beneficiary before you're not allowed to make any further contributions. So if you have a lot of means and multiple children, these 529 plans could work as excellent estate planning tools in your toolbox. Once again, these are my observations here. Please do check it out with your tax preparer and your estate planning attorney to see if and how they might fit into your tax and estate planning. And then the change to 529 plans that tilt in your and your beneficiaries' favor from Secure Act 2.0 are in the event that there were some funds left over after your child or grandchild graduates from college. You now have the opportunity to get some of the leftover 529 plan funds into a Roth IRA for your beneficiary. There are some rules you'll need to be aware of, but this was unheard of prior to a couple of years ago. To qualify for getting some of your leftover 529 plan funds into a Roth IRA for your beneficiary, your 529 plan will need to have been in existence for at least 15 years. The annual limit for contributions to a Roth IRA from your 529 plan is limited to the Roth IRA contribution limit of that year. And your child or grandchild needs to have earned income, a job. So earning at least that much and not so much that they don't qualify for making Roth IRA contributions to begin with. So another reason to lean on your grandkid or child to get a job, that here there's the opportunity to have some of your 529 plan money that's left over enter a Roth IRA for your child or grandchild. And then last, there's a total lifetime aggregate amount limit of $35,000 per beneficiary that can be transferred over from the 529 plan to the Roth. So just be aware of those items. And what this all means is that 529 college savings plans may not be just the Coverdell Education IRA savings alternatives that we all once thought they were. 529 plans now carry with them a lot more flexibility, utility, and opportunity for you and your family, well beyond the simple tax-free, high contribution limit vehicle that they once were considered to be. So after today's podcast, I'm hopeful that you're now more conversant in how 529 plans serve as investment and savings vehicles that are tax-free and potentially tax beneficial to you, and that work not just for college any longer, but for private elementary school costs up to $20,000 going forward for your children and grandchildren as young as kindergarten age. And further, we found out, depending on the state that you live in and the state's 529 plan that you contribute to, there could be state tax deductions for you to enjoy to make contributing to a 529 plan even more state income tax beneficial for you. And if you live in Virginia and are over the age of 70, you could additionally benefit your family by running current college costs through your Virginia 529 plan for much larger, potentially larger Virginia state income tax deductions, potentially well beyond what otherwise would have been a $4,000 annual cap. We also learned today that 529 plan contributions don't meet the criteria for being gifts of present interest or of irrevocable nature, yet you're still allowed to make gifts to them. And 529 plan contributions are not necessarily limited to $19,000, as you can advance yourself up to 5 years worth of gifting into 1 year. And from an estate planning perspective, even though your 529 plan accounts remain under your control, that they're not included in your gross estate for estate tax purposes. Quite a dislocation in your favor. And lastly, it's also important to know that with certain limitations, some of your excess 529 plan contributions could find their way into Roth IRAs for your beneficiaries for an added dimension of flexibility and utility for you and your family. If you have any questions about anything I covered today, I'll be happy to spend the time and discuss it with you further. Feel free to give me a shout anytime at 571-430-7200 or reach out to me via email at gregory.s.smith@raymondjames.com. Well, it sure has been fun being with you. I'm here today, and thanks for spending the time with me. My partner and portfolio manager, Chase Hinderstein, will be hosting next week's Wise Investor Show. And until then, this is Greg Smith, Senior Financial Planner with the Wise Investor Group, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.